happy or unhappy. So in your investment objective setting, really what you do is that you evaluate yourself, your objectives, and you identify the kind of risk profile that represents you. And the question you answer here really is, how much risk can I take and how much return do I actually want? Once you've answered that, you move on to your asset allocation, which is basically determining what fits that risk profile. And that question is, how much should I buy in different asset classes? So once I've come to an understanding, and hopefully it's an honest understanding of who I am and what I can really withstand, how much should I put in the different asset classes? And then we get to the real meat on the bones, which is portfolio construction. And the first two steps of this process kind of define the portfolio construction in large part for you. And there you answer the question, well, what should I actually buy? How do I actually populate my portfolio so that it represents how I feel about risk and the objectives that I'm trying to achieve? And in the end, this is a very sort of complex topic, exposure management. But really, what I mean by that is, sometimes we just feel like things are too expensive or they're very cheap, and maybe we need to deviate a little bit from the regular plan. And I don't think there's anything wrong with that. Banks call that sort of tactical asset allocation. I think basically it just means that you try to stick to your plan most of the time, but then sometimes there are some extremes which really merit some sort of action. And that could be, protecting yourself somehow. And it could be actually getting more aggressive. But we'll get to that a little bit later. So on investment objective settings, here we really need to start from the beginning. This is a really important exercise, whether you're independent or whether you work with a bank or with a broker. This person is not doing their job if they don't take you through this exercise. Everyone has to do it. Anyone that's regulated has to do it. So if you haven't been through this exercise, you have to go through it. And if your provider is not doing it, they're not doing their job. So the first step there is really in a investment objective setting, you need to kind of come to grips with your emotions. Risk tolerance is sort of the most important topic there. Are you going to freak out if markets, tank? Are you going to freak out, panic, and sell when you shouldn't be selling? Staying power, what does that mean? That means, can I really stick with my investments if all hell is breaking loose? Or, do I not have the strength to hold on? And then financial capacity. It might sound like this is all the same, but financial capacity is a different thing. Do I have the money? Do I have the money to hold on and wait and see these investments through? Or do I need to sell at a loss because I need to access my capital? Time horizon. Okay, so I use an extreme example. So I'm 100 years old. So what? Well, why is time horizon important? Because as we get older and older, we reach a point where uh, our time horizon changes because our needs in our life change. So as we get older, we may need more money to spend. We spend more on our children or on ourselves or on healthcare or whatever it might be. And as we get older, the time horizon of 5 to 10 years for investing and realizing investments starts to become maybe a little bit nerve-wracking. So you really have to be sure that you get your time horizon right as well. And financial knowledge and experience matter. I mean, some people have a lot, some people have a little, but it all matters. And it all matters because you have to really understand what you're doing, feel comfortable with your investments. In the center here, what I'm talking about is be aware of what is going on around you. Okay. And here we really talk about risk most of the time. So we measure risk by volatility in investments. Okay. So risk and return go together. So the percentage of return goes with the percentage of risk that you're taking, and that's measured in volatility. So what does that mean? Basically, what it means is statistically, your average return is going to be in the middle, and the volatility is going to tell you plus or minus at the end of the year where you might be. So if the average return is 10% and the volatility is 10%, then maybe you'll end up with a 10% return plus or minus 10%. That's very basically what that means. Liquidity, why is liquidity important? Well, for me anyway, in my opinion, liquidity is another risk mitigator. And when you invest in something, you don't necessarily look at how liquid that is, how much volume there is in that actual instrument. And so it could be that the time comes you want to sell and the price isn't what you thought it was going to be because there's so little volume or there's so little transaction taking place in the market that you don't get the prices that you should get. So it's very important that whatever you're doing is liquid so you don't get stuck. And then ultimately this translates into three basic profiles: conservative, balanced, and growth. You may have heard these terms already. Basically, they mean that, if you're conservative, you're on the lowest end of risk taking. If you're balanced, you're in the middle, and if you're growth, you're more of a risk taker. And the implication of the word growth is you want to grow your capital. Balanced, you want to earn more for your capital, but you don't want to take too much risk. And conservative, you just want to preserve your wealth. That's sort of generally and very basically the idea. And then at the end, when you start building this portfolio, and by portfolio, one shouldn't be intimidated. We're not talking about, necessarily something huge. It can be very simple, as you'll see the examples I give you later, just a portfolio of 3 lines. So it can be very simple. But when you're building this, you really want to manage your expectations. And what I mean by that is, there's no free lunch. So you're not going to make a lot of money by taking no risk. So you have to be realistic about that, and you have to manage your expectations. The law of averages applies to almost everything. So if you're thinking about equity as your risk asset bucket, if you put all of your money, 100% of your money in equity, and the potential return from equity is 10 to 12%, the potential return of your portfolio is 10 to 12%. The minute you start taking money away from that bucket and you start putting it in something more conservative, which has a lower return, you necessarily mathematically will be lowering the potential return of your portfolio. And you just have to accept that. You also have to be aware that there are, good years and bad years, and usually, they follow each other. And we just have to be able to accept that fact. And, sometimes it can hurt, but if we stick with it, we're okay, which is why patience is rewarded. And here I say obstinateness is punished, because it can happen that we feel very strongly about something. We have a really strong view about something, and we just don't want to admit that we were wrong. And we stick with it and stick with it, stick with it. We just bleed to death. Okay, so it's very important to be realistic. Now, until now, to be honest, let's say till the last couple of years, we had, 10, 12 years of, I think, unprecedented markets, zero interest rates in Europe, negative interest rates. So there was a phrase that was coined, TINA, there is no alternative, which basically meant that everything, was expensive. And the only thing you could really do if you wanted to get some return was invest in equity, because cash would pay you nothing. Bonds had already been bid up so much, the prices were so high that the yields were extremely low, so they weren't attractive. Even real estate, people had flocked to real estate because all the other yields were so low, so those prices were very low. So it ended up sort of shoving people down the risk spectrum towards equities. And as you've seen, equities have done very well. So one has to keep in mind that perhaps different periods of time, different things apply. So maybe in that period, the TINA principle of there is no alternative to equities applied, but this is applying less now. So now when we look at asset allocation with in a little more depth, here I've given you just sort of a chart which flows from the left, the least amount of risk, to the right, the most amount of risk. Very basically, if you're conservative, maybe you don't want to have any losses on your portfolio. You're not very willing to accept volatility. So you're sort of in a risk off mode. You just want to preserve capital. And you're in the center, you're willing to accept sort of moderate volatility and some amount of risk, because what you really would like to do is be able to grow your wealth in a manner that's not reckless, let's say. And as you move to the right, here you want to take more risk. You want your capital to appreciate. You want your wealth to expand. So you're willing to accept some higher volatility and some higher risk. And what I've done just below that is give you sort of a table, which are, sort of very rudimentary projections, from data that I took from S&P and so on, to give you an idea of, in these different buckets, conservative, balanced, and growth, how much equity, how much fixed income, how much cash would I have? And if I take sort of generally the expected returns for each asset class, what should I expect to achieve with these different mixes? Okay, now the volatility I put in there is just sort of a straight line computation. So just beware, it's just to give you some idea. In reality, calculating the volatility of a portfolio is more complex. It's based on, a concept in statistics called covariance. And so I didn't really want to get into that here, but just to show you sort of its average volatility. And when you actually calculate volatility of a portfolio, it's a much more complex computation. But this gives you an idea, right? So, in the conservative bucket, maybe you'll get a 5.34% return. Your weighted average volatility might be almost 7%. What you'll observe is when you go across, the returns get higher, the risk gets higher, but you may say, well, gee, I mean, it looks like I'm always taking more risk than I'm actually getting in return. And in some aspect, that's correct. This is sort of why the principle of risk-adjusted return is important. And when you calculate how good your return is, you really should calculate how good it is compared to the risk you're taking. Then you really will get an idea. But this gives you sort of a general flow. You can have a look at it later, and it gives you sort of an idea of what you're in for in the different profiles. Now, I've deliberately left out alternative investments. That doesn't mean they're not important or useful or good, but just keeping it simple, I think, is a good exercise for the beginning, and then afterwards you can expand and build. Alternative investments comprise hedge funds, private equity, real estate, and commodities. But at the end of the day, asset allocation, and this has been, studied and restudied, asset allocation contributes to 90% of your portfolio results. So if you just get those calls right, then you're in good shape. And frankly, from my own personal experience in investing, if you just had cash and equity and got the mix between those two right, you would be doing very well on a risk-adjusted basis, because basically cash has no volatility, has no risk. And so when you combine those two, if you just get the equity call right, you're in good shape. So then we get to the sort of meaty part, which is portfolio construction. Here really, I mean, you'll hear a lot from different specialists. From my experience, keeping it simple is the key, and that's how you really get efficient and satisfactory returns. We really just have three asset classes to work with. Again, keeping alternatives aside for now. That's equity, fixed income, and cash. Equity is the highest risk one, let's say, so that's where we'll start. Often the question pops up, how do you get good returns and mitigate somewhat your risk? Diversification is usually the answer. Is it worth it? In my opinion, most of the time, it's not really worth it when it comes to equity in particular. And that is because what I've observed from my experience is that, when the shit hits the fan, correlations go to 1. So when I, was in the business and we reviewed
Explain what you mean by correlations going to 1. Because I think some of the people on here may need to understand what that means.
Okay, fair point. Sorry about that. Basically, the correlation is a mathematical measure that will tell us how much in tandem the different things move. So if we have a bucket of equities and they all move in tandem, the correlation is 1. And so even if we have a bucket and it's diversified, it's the same as having just one, because all the movement is the same. So you're not getting any advantage in buying others. That is not the case. Usually, the more diversified you are, the better off you are. However, it can be confusing sometimes because you'll hear from bankers or specialists say, oh, you have to diversify. You got to put some in emerging markets. You got to put some in Europe. You got to put some in the UK, in the US. And it's a lot of work to do that. And even if you take the best managers who are best equipped to do that well, and you look at their results, what you'll find is that when there are important events, big downsides, that all the returns drift in the same direction. And so even though they're diversified, all those markets, whether US, Europe, Asia, all those markets will have gone down by a large relative amount, and therefore you won't really feel that you had any benefit in diversifying. Where perhaps diversification will help you out is on the upside, where the differences in a manager's abilities show more. But that's, I think, perhaps a little bit beyond this topic for now. But so to keep it short, I would just say diversification, I would not, subscribe to that unless sometimes it makes some sense. And there, I think it makes some sense if, for example, you're talking about equities, you buy an index, so to speak, through an ETF, but then you may want to buy, I don't know, something in auto. You might want to focus on automotive because in your opinion, there's a lot of potential there. And there, definitely you could benefit from diversification buying, let's say your top 5 picks instead of just putting all your money on one horse. Now, moving down the line, when we want to invest in this asset class, do we buy stocks? Do we buy funds? Do we buy ETFs? Again, here's just a personal opinion. I think ETFs rock. They give you the diversification, they give you the exposure, and they keep it very simple and very cheap. Very good example is the SPY, which is the symbol for the S&P 500 ETF. It makes getting the whole market exposure very easy. You just buy one unit, and the cost to do that is very, very cheap. Now, some people will perhaps dig a little further when they research ETFs, and they'll say, well, I saw something about replication versus synthetic. Don't get lost in the jargon. It basically means that if an ETF is investing in the United States stock market, in the S&P 500, you will have some that invest in the index by buying every individual security, and you will have some that invest in the index by buying derivatives that follow that. I would not subscribe to anything that doesn't follow by buying physical securities. It doesn't mean it doesn't work. I just think that there is slippage and some hidden costs that you may not be aware of. So there on ETFs, I would focus on full replication, which means they buy the underlyings. So let me just see if I can.
I think it's important to mention, Sani, that ETFs can give you themes. If you want to do auto, or you want to do healthcare, or you want to do AI, you will find ETFs that buy those stocks for you. So, if you want to express a theme, you can also do it via an ETF. You don't have to construct your portfolio yourself and pick all the line items.
Yeah, that's true. That's sort of the last point. So I'll jump there right away, which is, keep your changes to your investments high level. So as Louis just said, you may want to express a view on tech versus auto versus healthcare versus consumer. There are ETFs that can do that as well. And so I would keep all those decisions very high level and keep it very simple. In my case, for example, I focus, if at all, on growth versus value. That's what we call style. But I find that, every time you're adding a layer to the decision-making process, you're drifting a little bit from getting the first call right, which is just how much should I have in stock? And I think if you get that right, you've got most of the battle accomplished. Then in the center, fixed income, I actually think this is Louis' area of expertise, so I don't want to steal any thunder, but I actually think that fixed income is the hardest asset class. In fact, it was my bugbear. I never really liked investing in fixed income myself. It was just so hard to do really well. But that being said, Buying lines, individual lines in fixed income is just harder. When you buy a stock, you're buying the whole company, and that's that. When you're buying bonds, though, there are other layers of complexity. And just a simple example is you might buy a bond issued by Ford. It could be a 5-year bond, it could be a 10-year bond, it could be a 1-year bond, it could be a perpetual. There are all sorts of flavors which make the decision-taking process a lot harder. So for me, I just focus on ETFs there too, and I just say, all right, all I want to do is get the call on rates, and I want to get that right. And if I can get that right, then I get the call on bonds right, and then the next step may be risk, credit risk. So what I would tell you all, I mean, not knowing your different levels of knowledge, is when you think about bonds, think about deposits, because we all know how to invest in deposits, and we all know when deposits are a good idea and when they're not a good idea, when rates are going up, when rates are going down. So when rates are going up, you want to make your deposits longer or shorter, because you want to catch the rates going up as you go along. So you want to renew maybe your deposit every month, so that as the rates go up, your interest rate is going up. If you block your deposit for a year, then every time rates go up within that year, you're not catching it. So bonds are kind of the same thing, trying to simplify in thinking about bonds and their duration and their maturity. You should think about, well, does it make sense for me to invest in bonds right now? We had a question about that, which I'll get to at the end. Does it make sense for me to invest in bonds right now? Well, if you think that rates are on the way up, then you want to be keeping the bonds that you're buying as short as possible, so that as the rates go up, you keep catching higher and higher rates. And the opposite is also true. So I think if you think of it that way, it could be helpful. Stick with quality. That's just, something I would say for people who perhaps don't have the resources to investigate more complex bonds and more complex aspects of bonds, like high yield or other features like convertibles and so on. So I would just keep it, simple and stick with quality. But at the end of the day, I would just buy an ETF, an index that represents what I'm trying to get out of the bonds, and leave it at that. However, just to mention high yield, because that's something that comes up sometimes in our conversations, but also outside our conversations. Is it good? Is it not good? I like to look at high yield as a proxy for equity. So at times I may take some of my equity exposure and say, well, rather than actually buy stocks, I'm going to buy high yield. So I'm taking more risk vis-a-vis other, let's say, higher quality bonds, but I'm getting a higher coupon. And in the case of the company having credit problems, I'm higher in the capital structure than the equity anyway. So I get some benefit from that. So I look at it as sort of a quasi-equity exposure, which is not as risky as equity, but gives me good income and potentially a good upside as well. Here, I would just say buy when the spreads are wide. Spreads are wide means basically you buy high yield when it's paying the most it's paid over the low risk comparable rate, right? So if treasuries are paying 5% and high yield is paying 10%, great. Your spread is 5. You're picking up 5 additional percentage points. But if treasuries are paying 5% and high yield is paying 6%, you're taking more risk just for 1 additional percent. So look at the graph. I sent it once to the chat. Look at the graph of the differences between those two. And if you're interested in high yield, use high yield when the spread is the widest. And then we get to cash. Well, cash is kind of a no-brainer. We all know about cash, but that doesn't mean we can't optimize. So in cash, as I said, if you think rates are going up, keep your maturity short. You invest in deposits or T-bills if you can. You'll get good rates these days in the 5% range, and you can keep those short and when rates are going up. But when rates are going down, the opposite is also true. And that's where I think all of us in this chat and all of us in the investment world expect rates will start getting cut. We just don't know exactly when. But what that means is that as they cut and we renew those deposits or we renew those T-bills, the rates will get lower and lower and lower. So to answer perhaps ahead of time a question we had earlier, so what do? You have to extend. So if you think rates are going down and yields are attractive now is the time to buy longer dated fixed income securities. And then, sometimes money market is interesting. You see better yields in money market than in your cash deposits or T-bills. Just beware, there's no free lunch. So if they're paying you more, it's because they're doing something more. So if you're going to wade into money market funds, look at the fine print, see why they're making more. It could be that they're taking additional credit risk. It could be because they're extending their maturities longer and taking more duration risk, and they could cost more. So they may say, well, we justify that cost because we're doing more. Well, that's fine, but then you have to take that cost and see how much of the return it's eating up, so that you don't just invest in money market without thinking, and then at the end of the day, when you look at your returns, you say, oh wow, I would have been just as well off in cash. Then it's not worth the effort. So here, what I've done is just giving you a slide that shows you a very simple portfolio. This is what I do myself. So I'm not pushing anything that I don't believe in myself. And just to be clear, I don't make any money from this. I'm not looking for clients. I just, I'm interested in sharing what I know. And Louis was kind enough to give me the chance to do that. So this is what I actually do for myself. This is what I call my core portfolio. This is the bulk of my assets. And so what I do here is I just keep it simple. I have 3 lines. My equity, I use an ETF. The SPY is the symbol. That's the State Street S&P 500 ETF. It's super liquid. For the fixed income, I use an ETF. It's actually quoted in London, LQDA. It's basically corporate debt, US dollar corporate debt. It's a BlackRock iShare. And it's an accumulator because for me, for tax purposes, I don't want to touch the income. So an accumulator means that it rolls up, it keeps all the income that it generates in the ETF. It doesn't pay it out. That's what an accumulator means. Some pay out, but perhaps for tax purposes, it suits you as well. And then cash, I use another ETF, which is an X tracker. It's called. It's by a group named DWS. They happen to be majority owned by Deutsche Bank, and it's kind of like a money market ETF. I did some due diligence on it. I liked the returns. I liked what was underneath and the cost, and so that's my cash proxy. But that's also an accumulator because I don't want to touch the income and pay tax on it. What I've done here is then taken those 3 things and applied them as if I built a portfolio, conservative, balance, and growth according to what we looked at under asset allocation. And in dollar terms, if it was a $1 million portfolio, what would that look like in dollars and cents in terms of return, in terms of volatility? So the same numbers in percentages, but here just showing you, if you had $1 million, you took these 3 lines, what would it actually look like in dollars and cents? And what I've done here in the sort of middle of the page is told you that, if you have a strong view on treasuries, on interest rates, and you want to play that view, you can also consider an ETF that's called TLT. That's the symbol. It's an iShare. It sort of gives you a 16.5-year duration of fixed income exposure in US Treasuries. So if you wanted to take a position, if you want a part of your portfolio to be in US Treasuries and of a longer term nature, so that you can lock in those higher yields now for when rates go down, that would be an instrument that you could consider, and you could put that in the fixed income line. Now, what I've also done is given you some idea of how you can elaborate further in these different areas if you so choose to. I myself don't. Again, I think if you just get the equity call right, you're in good shape. And in my case, if you go all the way to the right, in my personal case, I'm on the growth side. I'm a growth investor. And that's because I feel very comfortable with the risk. I know what I'm doing. I've been doing this for almost 35 years, so I can do it in my sleep. And I'm not afraid of market movement. So for me, I want the maximum amount possible in equity and fixed income. In reality, I don't have a lot of fixed income. It's more like 20%, and the rest is 10% in cash. And that's done exactly what I've wanted it to do. But if you wanted to, you can look under equity. You can see, all sorts of ways you can go further with equity. You can go large cap, small cap. Large cap, small cap meaning the size in the market of that company. You can do sectors. There are 11 sectors, but I just put some examples, like you can be in technology, industrials, and financials, which means banks, real estate, etc., healthcares, and so on. You can also look at different geographies: US, Europe, emerging markets, etc. Style that I mentioned before: growth versus value, and blends of all of the above. Now, just to elaborate a little further on two of them. Geography, the reason I don't do the geographic diversification myself is I just don't feel like it's worth my energy. I've done correlation studies, so studies of statistically seeing how much the markets move together over time between the different geographies. And as I mentioned earlier, I found that they tend to move very much in tandem. So I don't see that much of a benefit. There could be times when there are extreme differences, and maybe one would say, well, gosh, now it's so obvious that the US is way too expensive and Europe is so cheap. Maybe you want to put a little in Europe. That's okay. I mean, I think probably important here to say is there are no extremes in this, and there shouldn't be. So you don't have to be black or white all the time, but I think it helps to only start drifting away from the simple when it's so extreme that it's obvious. Otherwise, you're really just making a lot of effort for marginal contributions. And then on the fixed income side, similarly, you have government, you have corporate, which are companies, you have emerging markets, you have high yield or higher risk, and you have short duration or long duration. Now, duration is a term that's often confused with maturity. They are not the same thing. So duration is very basically just how sensitive the price is to the change in interest rates. And it does express itself in years, but it's not the same as the maturity. And you can explore that further if you want. Just be careful when people use those terms interchangeably. They're not the same thing. And then just moving on to the last slide, exposure management. Basically, exposure management, what I mean here is, whether you hedge or whether you don't hedge, whether you protect yourself or whether you don't protect yourself. And there, I would just simply say, sometimes it makes sense, and that's when you do it, but you shouldn't feel you have to do it all the time. It's not something that makes sense all the time, and it's costly. If you do straightforward hedging, which tends to express itself by a forward is a transaction, it's a derivative transaction, which basically undoes what you have, then you have a linear payoff. You have a linear relationship. You reduce or increase what you have. If you use options, it's not necessarily linear anymore, because an option, as the name says, it's just optional. So if you buy an option, which can protect you from downside, then it has a level where it protects you. And from there downward, you have some protection, but it still allows you to grow on the upside. However, again, no free lunch. That costs money, and it can be quite costly. As a rule of thumb, I find that, if you're talking about equities, usually an at the money 3-month, and at the money means at the current level. So if you want to protect from the existing level, a 3-month option will usually cost 3 to 3.5% if it's reasonably good value, more or less. So you can imagine if you do that 4 times to do a whole year, that's quite expensive. And there's no hidden, hidden agenda there. It's just the volatility, basically. Other factors, of course, but basically the volatility that we talked about earlier, chopped up into the different periods of the year. And the way to look at that is that's insurance, just like health insurance, car insurance, any other insurance you take out, that insurance gives you some protection and you pay a premium for it. And that's it. I would say maybe now, Louis, if you agree, we opened it up to questions. We had some questions already, which I'm ready to answer, and I'll let you take it from
Absolutely.
here.
Absolutely. No, yeah. So, please. I think Christian had some questions that he put in the chat, and it works really well with what you were just talking about, which is portfolio insurance.
All right. Well, I'll start with his questions. If I'm right, is Christian on actually?
Christian, you're here, right? You're just I see no picture, but I see that you're here.
Okay, as long as he's here. His first question was which bonds to own in anticipation of lower interest rates. Well, as I mentioned a few times, when interest rates, you expect that they're going to start going down. Well, if you buy bonds or deposits or instruments of that kind, and they're too short term, then as you renew them, you're renewing them at lower and lower and lower rates. So just as a very basic answer, I would say you have to try to make them longer. Whatever bonds you're interested in buying, make them longer. Okay.
In a current environment where we think the Fed is going to lower rates. I mean, the
Yes.
second arrow to your argument is when you buy a long dated bond at 5%, let's say, and rates come down by 1%, your bonds are going to rally in order to give you a better yield. So in other words, if you get it right, bonds can begin to give you higher returns because you locked in those yields, and as yields come down, they have to go up in price in order for the yield to come down.
Right.
So
Right.
it's a win-win if you get it right.
Yeah, and that's what makes bonds attractive vis-a-vis cash. So someone may say, well, if cash is paying 5%, why do I bother buying bonds? Well, precisely for that, because cash will give you 5% and that's it. It won't give you any capital appreciation. And that capital appreciation you can calculate, again, very basically just by saying, you take the change and you multiply by the number of years. So if the change is 1%, if it's a 5-year instrument, then it's 5%. That's the capital appreciation more or less that you'll get if you have that, plus whatever interest you have in the meantime. But just to answer the question with a little more depth, again, not knowing who knows what on the chat, technically, the most sensitive instrument for this is a zero coupon bond. And the longer, the more sensitive. So without getting into the details of that, if anyone wants to maximize the amount of movement that they can get from an interest rate move, that would be what you should look at. And if you're interested, there's an ETF. It's by PIMCO. That's a very well-known bond manager, and it's called the Z-ROZ. So ZROZ. So if you're interested in investing in some instrument that can give you that, that's what you can have a look at. A second question was, what's the ideal war portfolio? Very interesting question.
That is a good question. I like that.
That's a good one. I don't subscribe to, that extreme. Again, I think we should be careful of extremes. If you say, okay, what's a good war portfolio? I get the question. Just be careful not to think that all your money should go into a war portfolio because you expect there to be war. Okay. I think the implication of the question is, if you are afraid of some geopolitical risk, what are the areas that benefit? And there, I would just say generally, if you're an equity investor, war has a short-term impact, but long-term, it doesn't change much. And in fact, in some cases, it can be very helpful because rebuilding afterwards leads to economic growth. So what I would say though is that if you want to address geopolitical risk and you want to reduce some risk, be a little more risk off because you're afraid of increasing geopolitical risk, then when it comes to stocks, you buy more defensive stocks. That means better quality. That means sectors like healthcare, food, and things that are inelastic in their nature and that tend to benefit when risk starts to go up and people want to be more defensive. You buy government bonds because when people, asset managers or otherwise, want to take money out of risk, they will exchange it for the lower risk or the lowest risk instrument, and that would be government bonds. In my case, that's U.S. Treasuries. But then there are other things, like gold, Bitcoin. Bitcoin we've talked about a lot on the chat, and I've expressed my views about
Oh
that. But
yes.
I think if you consider Bitcoin a store of value, gold a store of value, those are things that you would probably want to have in case we're afraid of the war risk. But also one more that I would add here is the Swiss franc as a currency tends to benefit when geopolitical risk spikes. And you may know Switzerland well or not, but it tends to be one of the safe haven jurisdictions and currencies, and so could be something you want to think about if you want a war portfolio. And then the third question was, is it useful and cost effective to protect a portfolio against a black swan event? Very interesting question also. What I would say here is, by definition, a black swan event is something that should not happen that much, if at all. And so if you're trying to protect against that all the time, you're going to be paying a lot of money for nothing. So I think more what I would say here is, if you think, for geopolitical reasons, economic reasons, whatever reason it might be, if you think we're reaching a point where something extreme could happen, then you would increase your exposure to those lower risk things, or you would, buy treasuries, or you would protect yourself for that moment. Now, as we said, it's quite expensive. So if it's something that you think might happen, but you really doubt it could, but it's more of a conditional value at risk situation where you feel that if it happens, it's going to be major, then that describes an event that's sort of way out in the probability, but that when it actually occurs has a huge impact. So there, I would say, if you really think something like that might occur, you can do what I do. And what I do is, when I feel that way, I buy put options, which are options that protect you from downside, but I buy them far away from today's price so that they're very cheap, in the expectation that if that swan-like event that you're talking about takes place, you will very quickly move from today's price very much closer to the price of the option. And therefore, suddenly that option will jump in value. In the meantime, if that does not happen, it hasn't cost you a lot. So I would say in that sort of scenario where you're afraid of an extreme event, that's something you can do. The other thing you can do is just go to cash. But I strongly avoid that. And the reason I avoid that is, as I said, because those events tend to be very rare. And when they happen, usually nobody has predicted them. Everyone is caught out. And as a result, if you just have a good strategy in place and you stick with it and you occasionally hedge, you should be fine in all those circumstances. Then there was another question that came in at the end. Do we expect steepening or flattening of the yield curve? And is it worth doing something, I suppose? I think it's already flat. And you can see that from the numbers, and you can see that from the chart. In fact, right now it's inverted. Inverted meaning the short-term rates are higher than the long-term rates. Usually you should get paid more for giving your money out for longer. So when that happens, historically, that means, you have a dislocation and a recession is coming. That's historically what that's pointed to. It just hasn't realized. But ultimately, if rates go down a little bit, even like first step, second step, the curve will be completely flat. I just don't think it's worth trying to bet on whether it flattens or steepens. Also, because if you're betting on a steepening, steepening implies going up, but it could invert more. And it could invert more even if short rates stay where they are, just because long rates go down. And long rates can go down if, as you said earlier, people flock away from risk and they start buying the 10-year treasury. The yield will drop from where it is now at about, 420 down to 3.5, 3 or more. So the inversion will actually be worse. So if you've taken a bet the other way, it's going to hurt you. So I just think it makes sense to just keep it simple and to say, we all believe interest rates are going to go down. Everyone's been wrong about when. So let's be humble and let's say, okay, they will come down. We just don't know when. And maybe the positioning we should be thinking about is when the 10-year gets to 4.5, then maybe it's attractive to buy that. And when the rates come down, I'll make money from that. I would just keep it that simple.
Do you want to talk a little bit about, there's a question about VIX, which is complicated, but we can talk about VIX, but do you want to talk about other instruments? There are inverse ETFs or ETFs that go short the market, et cetera, et cetera. So not that I'm suggesting people time the market, but, option strategy is one way of protecting against your downside. Another way is to buy instruments that specifically go up if the market goes down or certain components of the market go down.
Yeah. Happy to address that. Well, for those who might not know, the VIX is a measure of the volatility component in the 3-month at the money option related to the S&P 500 index. And
it's called the fear index, the fear gauge, right? It goes up when the market's afraid.
That's a measure that's sort of, followed quite widely in finance. Now, would it be beneficial to load up on it? Well, first of all, investing in it's not as straightforward as it seems, and there are ETFs that do that, but to be honest, I've watched those for a while. They're not very good.
I agree with that. Yeah,
and they just don't deliver what you're hoping for. And I've mentioned in our WhatsApp chat before that I think if you want to do that, the smartest way is, again, keep it simple and just buy put options, because put options have that VIX component, if you like, embedded in them. And they have it in the right direction, which means, if you buy VIX or you buy volatility and the market goes up, usually volatility drops. So when you buy a put option, you get the best of both worlds, because when you buy a put option, if the market goes down, your put option value goes up, but also volatility goes up. So you gain that volatility premium, so to speak, that you were looking for. That's how
Sani, so I think we're going to run out of time shortly. Would you be so kind as to share your presentation, the link in WhatsApp after this presentation?
Sure.
And why don't we actually ask one more person if they want to speak and ask a question? If anybody wants to take their mic off and actually ask a question, please do so that we get some participation. No one? Everyone's shy? Bruce, Anil, come on. No one? You guys? Nope.
Come on, there must be something.
Hey, I'll ask one.
Come on,
Sani.
go ahead.
I'm an investment professional as well. It's a great presentation. Really like to keep it simple. How do you tend to manage ETFs when the markets are reasonably high? So in my own portfolio, that's my only concern, is you kind of tend to follow what happens in the market. Do you kind of go active managers or tend to pick a few more sectors yourself to manage that downside risk versus ETF investing? Or how do you kind of view ETFs when we feel like markets are reasonably high?
Excellent question. Well, let me start by the active management aspect. What that means for everybody on the call, active management is referring to somebody actively managing instruments to try to beat the market. I think that can make sense if you have the resources. You know, I worked at JP Morgan where they had a great platform, you know, for assessing managers, but they spend a ton of money on that. And to be frank, I just, you know, sometimes you saw the value, and when you saw the value, it was in upward markets, which is what I was alluding to earlier. That's where the dispersion in active managers play to your advantage. However, you know, picking a manager, if you have those resources, or you do bank with somebody who you like, and they can give you that sort of advice and platform, you know, be aware of the cost, because it's costly. And a lot of the time, active managers just don't beat the S&P. They just don't. And so, you know, it's pointless in a way. However, what you referred to earlier, like sector or specific exposure, like, do you want to take a bet on something? I'm all for that. But the way again, the way I would do that is to say, okay, I have a core portfolio, and maybe I'm going to carve out some of that money, and I'm going to use that to express a very strong view. It could be, you mentioned sector. Let's say I really believe in tech and AI right now. So I really want to have additional exposure there, because I think those stocks are the ones that are going to drive future returns. You can do that. Then what you do is you take your portfolio and you split it into two. You have a core portfolio, which is the biggest lion's share, maybe 90% or 80%. And then you have what you would call your satellite portfolio, which is maybe 20% or 10%. And in that 10 or 20% is where you play. And that's where you will say, okay, I will put some in NASDAQ ETF, because I want tech exposure, and I want to overweight that exposure. As long as you do this in a methodical fashion and you know where you stand, and when you make those bets, you get the sizing right. And by sizing, I mean, if you put 10% of your portfolio in the NASDAQ, well, you can calculate how much that's going to hurt you if it goes down. So the sizing matters insofar that your betting portfolio, if you want to call it that, should be smaller, a lot smaller, but because it has a much bigger potential upside, perhaps, then maybe if you put 20% in your satellite portfolio and you make 20%, you're adding 4% return to your overall portfolio. That's good. But if the opposite occurs, you're detracting that amount, and it's not going to kill you. So that's kind of what you have to decide as an individual investor. How far do I want to go with this? How much pain can I take? And then you're good. Does that answer the question?
Yeah, I like that, the core satellite approach. I tend to kind of satellite into a lot of alternatives, private credit, and kind of think of my satellite as outside of the kind of regular domain of investing that you've covered today. So that's how I approach things. And you're right about staying invested and staying true to your strategy, because over time, the kind of corrections do occur. So it's really just a mental space to, you know, handle your journey throughout investing in the short term. But yeah, thanks.
Yeah. What else I would say, you know, in response to your question is, you know, you asked about, you know, maybe it getting expensive. you know, we're expensive right now, and I think we all know that that's because of the likes of Nvidia and Broadcom and you know those AI stocks pushing the average return of the market up, and so value wise, the market's trading at 20 and a half, 20.5, getting close to 21 times. You know, that's historically that's expensive. But maybe it's not the time to make a move, I would say, um, because of that factor. And that's where, you know, you have to be careful of averages and using averages because the index is an average. Is that those small numbers of companies are driving the market right now. There's a lot of lag from all the others. Now, if the others start running, even just moderately, then the whole index is going to keep going up. So I would say the way to look at it is maybe, you know, I think this market can flex up to 22, 23, maybe even 24 times. When you start going past 24 times though, man, you're pushing your luck. So I would say when you start reaching that point and you start feeling that you're pushing your luck, don't disassemble your portfolio. Don't take apart your portfolio. Buy some put options. And that's something that, you know, I know it's difficult to do. You know, I'd be happy to give you some tips if you want offline. But basically, you know, when you reach that extreme point, that pain point, that's when you might do it. And you don't have to be extreme about it. You don't have to do all or nothing. You can just say, well, I'm just going to take, you know, I'm just going to buy some protection just in case, you know, now we are at an extreme and we back off a little bit. You know, 10% correction is not a big deal. And what I think maybe now what I'll mention is I put at the back of the presentation a bunch of slides. I would say this one, for example, is good, but on the equity here, this slide right here. So to answer what you were talking about in a different way, this slide shows you going back, you know, quite a bit. The returns in a year for the year and within the year. So what you will see is those red dots show the low points during that year. So you can see in some circumstances, for example, you know, sort of 2003, you can see sort of in the middle of that picture, you'll see a 26% upside. The year finished 26% up. But there was a point that during the year where it was down 14. Okay, that says it all for me. And this is one of my favorite charts. Credit due to JP Morgan. It comes from their guide to markets. I've put, you know, my sources and all of these things so you can see where the information came from. I didn't invent it. And this is very useful. I think this tells the story. So if you feel, whoever spoke just now, I'm sorry, I didn't catch your name, but if you feel that you're at a point we're coming to a point where we're reaching an extreme, you can get a little protection. You can buy some put options, maybe a little out of the money if you don't want to pay too much. Just, you know, be sure, you know, to understand how they work, and understand that, you know, most options go on exercise, so the money usually is spent and you don't usually get it back unless you take it off. So what I do myself is I use the SPY, as I said in the presentation. When I think I'm reaching an extreme point, I will buy some put option protection, not on the whole thing, just on part of it, so that I know maybe my target exposure is 70% equity, and I take some protection, so it brings it down to 60. And then when we flex more on the upside, I'll take some more protection. It'll bring my exposure down to 50. And then if there's a 5% correction, I'll take some of that off. And then if it's a 10% correction, I'll take the rest of it off, and then I'll be back to 70% in the market. That is the way to do it. You do not buy and sell your portfolio all the time based on that. Otherwise, you'll never be invested adequately when the time comes.
If I had to describe that, Sani, I'd say that's exposure management, right? You're managing your exposure. You're doing it via options. The classic way to do it is to take part of your portfolio, go into cash. I mean, one takeaway from this chart, when I look at this, in the bad years, the years after a bad year were typically very good, right? So you've got to stay in it to win it as well. So maybe you reduce your exposure as the market is beginning to punish you, but at the same time, you want to be reinvested for the next year. You don't want to actually have the market dictate whether you're invested. You want to be a longer term investor and adapt your exposure over time, but still be involved in your portfolio, have a portfolio invested in the market.
Yeah. I mean, you had a slide at the very beginning which showed the asset class performances over time. And I love that one because that's a great slide, because basically what it shows you is that equity always outperforms everything else.
Yeah.
And we've had a huge stretch of fixed income performing extremely well because of quantitative easing.
Yes.
That's over.
That's over.
When you invest in a bank in their standard portfolio, they have guidelines they have to follow. They have to be in bonds to a certain extent all the time, even when it doesn't make sense. That's just, they have to, because their benchmark follows that. I don't have to do that. So I'm not saying you should time markets, but I'm saying when something is glaring you in the face, you had 10 years of zero interest rates, man, that's going to end one day.
Well, it has, right? It has.
Even if you're a little, right? Even if you're a little early, better early than late.
So the key takeaways from today's talk. What would you summarize? What do you think the 4 or 5 main points are?
Well, I think you have to have some process, and it's kind of boring, but it works. So you have to have some process. You have to be honest with yourself about how you're going to behave when markets move. And then I think that helps you formulate a strategy, an asset allocation, a plan.
Mm-hmm.
Once you have your plan, you then start going shopping. You buy a few things, some very simple things. When you load the presentation, our guests will see in my notes that I went into more detail in the notes. And in my notes, I said, look, just imagine if you did this exercise for every region: US, UK, Europe, Asia, emerging markets. Okay, let's say 5 regions. And you just picked 5 lines in each asset class. You suddenly end up with 80 lines. There's no way you're going to follow that. So the other takeaway is just keep it simple. Keep it to something you can actually follow. You should be able to know what you have at the top of your head. And if you can't, you're out of control. So I'd say that's another very key takeaway. And then, as you said, you have to be in it to win it. So you have to stick with it. That doesn't mean you have to stick with it blindly, but it means you have to stick with it. And then occasionally you do the fine tuning. And that's when you might say, geez, I made so much money that I didn't expect to make. Okay, take some profit. It's nothing.
Yeah.
Nothing to
The
be
fine
ashamed of.
tuning. I like the way you described that, the fine tuning, because I think people tend to be very reactive with their portfolios.
Yeah.
So that makes perfect sense. Okay. Well, listen, I very much appreciate your time. That was a very clear and concise presentation. I hope that everybody enjoyed that. The people on the call, was that a thumbs up? Yeah. Okay. Good. Fantastic.
Great.
We'll post a
Thank you
link to
very
the
much.
slides and post the links to the slides afterwards. And thank you for the time, Sani. By the way, he's in Mexico, so now he's going to go out and have a beer in the sun and hang out and chill out. So there you go.
I wish, actually, truth be told, the market's open for me. So
okay, so get to work.
This morning I bought puts on Broadcom. And
okay.
I don't know how they're doing right now, but
so go find out.
I hope they're not doing so well.
That's kind of the idea with puts. Yeah, we hope so as well. We'll have a quick look. Thanks again to everyone, and we'll record the call, and I'll distribute the call. Thanks a lot.
All
Bye-bye.
right. Thank you very much. Bye-bye.